All right, it's great to be back, Dan, and thank you very much, and thank you for that introduction. And I'd just like to ask all of you a quick question, and that is, how many of you have ever attended a webinar by MarketGauge or by me? Are you familiar with MarketGauge? If you just give a Y or a no, that'll give you a good sense of the audience. And if it is your first time, congratulations. For those of you who have heard us before, great. Love to have the repeats. All right, so we've got a good mix of both. And so the other thing, I'm going to talk about an approach and tactics that you can use for day trading, swing trading, even putting on option strategies. So I'm curious if you could let me know how you trade. Are you a day trader, swing trader, both? And do you trade options, right? So day, swing, options. If you just let me know what you do. That'll help me get started. All right, so we've got, and yes, this will apply to futures too. Will apply to Forex too, but I am going to focus on equities and ETFs. All right, great. So we've got quite a mix, and a lot of you do all of the above. All right, so I entitled this presentation, How to Pick the Best Days to Enter Swing Trades, Day Trades, and Option Strategies for Immediate Profits and Maximum Potential. Now the key here is because that's a description of exactly what I want to do in this presentation. I want to show you how to find the best days for immediate profits and maximum potential. And those two things really go hand in hand. Now, I'm not going to read through these quotes, but I want to warn you that, well, I'll get to that in a second. What I would like you to get out of this presentation is a lot like what these people have gotten out of it. I want you to be able to walk away from this presentation and have a much better understanding of how the markets work, how you can trade more confidently, and obviously trade more profitably. And I always like to make trading as easy as possible. And this is why I show you this second quote here, and I highlight the bottom part of it in yellow, because this really encapsulates what we try to do at MarketGauge. Not that we want to be Albert Einstein or pretend to be anything like Albert Einstein, but he said everything should be made as simple as possible, but no simpler. And what I'm about to show you here, for some people, often seems like it's just way too simple. Can't be this easy, Geoff. And then I hear stuff like, it completely changed my style of trading. All right, now I've blanked out what this person was referring to because I don't want to give it away before we get into it. Now, I am going to be talking about a real trading strategy that I use. We'll even talk about stocks that I'm in. And if you stick around to the end, we'll go to live charts, and we'll probably be looking at some stocks that I'm in and some trades that I've done, and even some trades that will be potentially set up to be moving right now. As it happens, we're at a pretty interesting inflection point in the S&Ps, and this is directly applicable. All right, so who would enjoy trading a lot more if every day was a bull market? How would that be? Would that make trading easier? Right now, I'm not suggesting that there are no corrections or no retracements, right? I'm just suggesting that in a bull market, it's generally easier to trade, is it not? So that's because we've got rallies that are big, and there's plenty of time to get in and out with big profits, right? But really, why are bull markets so much easier to trade? More specifically, all right? They bail you out. All right, when you're not right on your initial position, you can get bailed out if you're trading from the long side. And so what does that really mean? It means that if you could identify more reliably when that market was going to turn and turn back in your favor, or you could identify when that breakout or that resumption of momentum was going to continue and not pull back on you. I mean, how many of you have had the situation where you buy a stock that's going up, and then almost as soon as you buy it, it seems to reverse, right? In a bull market, you don't have to worry as much because it'll eventually go back up. But what are the most frustrating parts of this current market? Okay, we've had a nice bull run here, and we're starting to kind of chop. But if I can help you with certain things about your trading, let's relate it to the current market. What are some of the most frustrating things that you're experiencing right now in the current market? So I've got some that I've come up with here, which I think you'll agree. Meager rallies. I mean, we've had a pretty good run since February. However, the rallies haven't. It's been kind of choppy, right? The price action's been kind of choppy, even though we tend to move up. So someone's saying China, blame it on China. Overnight moves, in other words, gaps, right? So with gaps, though, gaps can be frustrating if they go against you, but they're great when they go with you, right? And not only that, gaps, kind of like today, sometimes can be a huge opportunity. False breakouts, yes. And what about sudden plunges? Any of you gotten caught in one of those days where it seems like it starts off bad and then just gets worse and worse and worse, right? So this is why I wanted to put together this presentation so that you can really be focused on entering your trades at the right time, because timing is so important, but it doesn't have to be all that difficult, right? It doesn't have to be complicated. All right. Now, when I say you want to enter at the right time, to me that means where you're comfortable with the risk and with confidence that you'd close the day profitable. All right. Does everybody agree that you feel much better if you're in a swing trade when you go home with a profit than when it's against you? If you're a day trader, you have no choice, because if you can't do that, then you're not going to be a day trader for very long. Right? So that's what I mean by entering your trades at the right time. That's what I mean when I say we want to be immediately profitable. All right. Now, let's say you could do that. Let's say you could enter trades, and when you did that, you were reasonably, let's say very confident that you'd be able to end the day profitable. And then it turns out you are profitable. So when you end a day profitable, isn't it easier to manage the rest of the trade? I mean, can you manage trades better when they're profitable versus when they're unprofitable? Which way is easier? I would argue that the profitable trades are much easier. In fact, I'd argue there's a lot less stress when you're managing a trade that's already unprofitable. And I'd also suggest trading is a lot more fun when you're profitable. And not only that, it's definitely more profitable. So if you can get off to the right start, it makes a huge difference in how you trade. I mean, of course, if the first day is profitable, it makes it a lot easier to manage your trade. So this presentation is going to be completely focused on one big thing, right? How to enter, and how to enter in a situation where you can get immediate profits and also do it when you've got the maximum potential. It doesn't matter whether you're swing trading, day trading, or entering option strategies. This approach will be applicable to what you're doing. All right? And this, in my opinion, is so important. Even though when I coach individual traders, I focus also on the fact that where you get out is just as important, and sometimes more important than getting in. If you can't get in at the right time first, trading is just a struggle. And I'm going to show you how I can do it without any magic bullet indicators. All right? Now, I use a lot of these indicators, and many of you probably do too. Moving averages, MACDs, ADX, RSIs, Bollinger Bands. I don't use them all, but I have nothing against indicators, but you don't need them. If you take what I'm going to show you right here, this is a building block, and indicators are just icing on the cake if you really want to use them. Right? Now, as Dan had already said, MarketGauge has been around for a while. We started by servicing large institutions, and we did that because we were working, my partner and I were working at a hedge fund and developing tools for our own trading, and we wanted and had the opportunity to make them available to other professionals. So just quickly, I've been doing this for over 25 years. I started as a floor trader, as I think Dan pointed out, moved to up to a hedge fund, which was a quant-based hedge fund, and ever since then have worked in the mode of being very quantitative, very rules-based, building trading systems. But all through all that, we always focused on this one concept that I'm going to show you. But before I get to that, let's be real. And what I mean by that is it's really easy for me to get on this presentation and say, hey, look, I've been doing this for 25 years, since 1990 professionally, right? And you know, a lot of times when people come on these presentations, it sounds like, oh, you know, it must be easy for them. But it's not, all right? Everybody, I don't care who you are, and this is one of the best examples recently. Bill Ackman, $1 billion in one day is small compared to what he lost so far on this whole Valeant mess, right? Everybody has rough periods. And so when I have gone through rough periods, I've stepped back and I've focused on the core things that enabled me to do exactly what I've just started this presentation with. How can I get into positions with the least amount of risk, the most confidence, and have them end profitably in that first day as often as possible, right? Because of everything I just said. If I can do that, everything starts to fall into place. So I've called this kind of my 3 steps to success method, right? And as I said earlier, when we get to Q&A, we're going to look at some stocks and apply these 3 steps to stocks that are trading today. All right, so the first one is the market. We want to focus on what's the market doing. And here's a simple reason why, and I think most of you have probably heard this before. 70% of a stock's move is due to the market. So it's really important, or really to your advantage, to know which way the market's going. And it's not that difficult. Have any of you heard of the opening range, the concept called the opening range? Now, I'm guessing for those of you who have seen a MarketGauge presentation, while we don't only focus on the opening range, you've heard of the opening range. But how many of you have not heard of the opening range? Anyone? Okay. All right, so the opening, first of all, the opening range is an incredible predictor of the daily high and low of the day. In fact, it gives you a statistical edge. And when I say the opening range, I'm referring to the first 30 minutes of the day. So the first 30 minutes of the day represents 8% of the trading day. If you take the high and the low after the first 30 minutes of the day, so stocks open at 9:30, at 10 o'clock, you know what the opening range is. 50% of the time, the high or the low of that time frame will be the high or the low for the day. So what does that mean? After only 8% of the day has traded, you know what the high or the low is going to be 50% of the time. Now, all you have to do is know how to use that edge. I'm going to show you a really simple way to use this as a roadmap for the market and then a roadmap for your stocks. And when you get a little more into it, you can actually increase that number of 50% to 83%. All right? And that's what we call the 83% trader's advantage. You apply a few extra rules and you'll get a much higher percentage. That's not to say that 50% isn't high. So let's just review, or let's just go through a little exercise, make sure everybody understands it, because the rest of this presentation is going to leverage this statistic and this phenomena about the market. So if we look at 5-minute bars, I've got 5-minute bars set up here for this demonstration, but you could look at a 30-minute bar, right? If you have a 30-minute bar, it's the high and the low of the 30-minute bar. You could look at a 1-minute bar. If you look at a 1-minute bar, you're going to look at the first 30 bars. So we're looking at 5-minute bars, and that means that this is the highest high of the first 30 minutes, because this is 10 o'clock, this is the open, and this is the low, right? So this level for the rest of the day is going to be our opening range. All right? So the basic concept behind this is that when the market opens, it kind of resolves or battles with all the news that may have come out overnight. It's also a time when people are trying to establish their positions for the day. So if you let the market kind of digest its initial thinking, that you get your opening range, and then the first way you want to look at this, and we'll talk about a number of ways, is that when the market gets above that 30-minute high, the bulls are in control. When the market goes below the 30-minute low, the bears are in control. In between, it's either neutral or completely undecided. Now, there are situations, many, where you have a bullish bias or a bearish bias, in which case you're able to take advantage of these levels in different ways, and we're going to go over that. But for right now, for this slide, all you need to know is that above the opening range, bulls are in control. Below the opening range, bears are in control. All right, so just knowing that alone gives you a sense of whether or not the market is in a trending mode or a choppy mode. Now, I just hinted earlier that if you take that simple concept and then combine a few conditions. One condition is whether or not you're in a bullish mode overall or a bearish mode overall, for example. And two other conditions. You can increase this percentage all the way up to 83%. But actually the more compelling percentages here are when you break it down to just the low or the high of the day. And so let's focus on the low for a second, because I'm going to focus on buying against the low today, but the same could be true of selling against a high. Now, on any given day, 27% of the time, that first 30 minutes will be the low of the day. However, when you use the 83% trader's advantage, 62% of the time that low will be the low of the day. All right, so that's a dramatic improvement, even though 27 is great to begin with, because remember, we're talking about the first 8% of the day. All right, so that's what I mean by that trader's advantage, and we'll get back to that. All right, so if you use the opening range correctly, you'll never get crushed by being on the wrong side of a big trend day, right? Because if you use the low of the opening range as your indication that the market is going down, you shouldn't get caught in those big trending days that just keep going down and down and down and down. All right? So to answer the question, and we will do Q&A also, the opening range does not include the gap. The other thing the opening range will do for you is it will enable you to anticipate the high and the low of the day with amazing regularity. And think about what I've just told you. Part of that is because you know after the first 30 minutes that you've got a certain percentage of the time that's going to be the low of the day. All right, so even before the market gets there. And not only that, because you know it's going to be the high or the low of the day, it provides great stops and great targets. Right, so let's go back to that description or the chart and see how this works. Here's the 30-minute opening range. And what are you going to look for if you want to find a trend day? You're going to look for a situation where the market breaks out of the 30-minute opening range. Now you want to break out not by just a little bit, and really you want to break out and you want to break out and then continue. All right? And when you do that, you then entered into a day that's likely to be a trend day. Now, when do you know that the trend day is no longer a trend day? Well, your first warning sign is when it breaks back down here. It doesn't have to go all the way down to new lows, right? But there are several different patterns to look for, Sometimes you will wait for the low, depending on your risk, depending on a couple of other things that we'll talk about. But for more or less, if you're expecting the market to go down, maybe you like to be short, and it breaks out over the high of the opening range, you shouldn't be getting crushed as this thing trends higher, because that's what markets do when they break out of the opening range. Same thing on the downside. Now, this is just a quick illustration to show you what this really means, and also to show you how you can go test this out yourself. Don't take my word for it. All right, these are 30-minute bars on the SPYs. I picked a period of time where the market's relatively choppy, and one of the other ways you can improve on the opening range is to not be so strict about the high. Give it a little bit of fudge factor. Don't call it to the tick. Give it a little area around that high. Just like I said on a breakout, you want it to break and then continue. Now, with these bars, or with these arrows, the green arrow represents a day when the low was the low of the day. A yellow arrow pointed down means that it was close enough to be called high of the day, or red, high of the day. So if you just take a look at this, I would say almost random segment in time, but a choppy period, 9 out of the 11 days, the opening range was almost exactly the high or low of the day. All right? So if you're not looking at this, this is literally a hidden secret that's been sitting right in front of you the whole time. And when it's choppy, it helps keep you more relaxed about which way the market may or may not be going. And when it's trending, it provides an amazing edge to be able to buy against the low of the day. And the other thing it does is that when the market's trending, not only does the low of the day become more reliable, but the high of the opening range becomes more likely to be broken out of. All right? So putting those two things together, you can really give yourself a huge edge simply by knowing this fact. And again, if you just take a look at these arrows, I encourage you to go do this on your own charts. Use a 30-minute bar. You can see the first 30-minute bar. That's your high and the low. And you can see when this market's trending up, it tends to be the low. When the market starts to roll over, it tends to be the high. All right? And that's how come 50% of the time, either the high or the low. Does this make sense? All right? Anybody who doesn't understand the basic concept at this point? All right? Great. So 70% of the stocks move is due to the market. So which way is the market going? So let's take this concept, all right, and make it even more powerful. And if there's one thing besides the opening range that you were to take away from this presentation, this would be it. All right. Now we got a lot more coming after this, but this is so easy to do and so powerful, and it's just so applicable to almost every day in the market. And it is, don't rely on one index to tell you which way the market is going. All right. Markets rarely trend alone. So if you want a good trending day, you want 3 or 4 indexes all doing the same thing. If you don't get that, you're likely to get reversals and chop, and we're likely to get it right around these opening range highs and lows. All right, so you can see these divergences really easy. Here's an example. So the way I suggest you set up your screen, obviously there's plenty of variations of this, but I've got ETFs for the SPYs for the S&P 500, the Qs, NASDAQ, the Diamonds, the Dow, and IWM for the Russell 2000. If we look at the first 30 minutes on each of these charts and look at how each market is trading around that important level, you will get these patterns of either agreement or divergence. So in a word, if they're all doing the same thing, if they're all breaking the same opening range level at the same time, you've got a much better chance that that particular day is going to be a trend day. So look what happens on this particular day. Markets open up a little bit, maybe basically unchanged. They sell off. I'm looking at the SPYs in the upper left. The SPYs rally up to about the high of their opening range. The Qs take it out by a little bit. The IWMs take it out by a little bit. But why would you think that maybe they're not quite ready to go? Well, for one, the Dow doesn't even come close. The SPYs don't break out. None of them really close over it, and then they start to roll over. All right? Now, when they go down, the Dow looks like, if you're just looking at the Dow looks like it opens lower, tries to rally, and now is going lower again. But if you look at everything else, the Dow is the only one that broke down. So now they all start to rally back up. Now, you could either be driving yourself crazy thinking the market's going up, the market's going down, or you could be waiting saying, you know, until all these things are doing the same thing, like right here, I don't want to get driven crazy by these little fluctuations. Then they all break out, and you get your trend move. Now, because this goes back to how well can you manage your position when you're profitable, when you're not. All right. So if you get a breakout and it's not initially a head fake, isn't it a lot easier to stay with that? I think so. So let's take another example, and this next example is actually going to be the very next day from this example. So next day, let's assume you don't even know what happened the day before, but you get the same exact pattern, right, or a very similar pattern. And what's that? In this case, we gap down. That's a little bit different, right? But then you have some fluctuation. SPYs try to break out a little higher. Dow tries to break out. Qs, not even close. IWM, not even close. Right? When they go down to the bottom of the range, they all break down. It's a negative day. All right. So would that help your trading if you could see the markets that clearly every day in the direction that they're going to go in? Now, don't be misled, right? Not every day is going to be this crystal clear, right? But with a little practice, just like everything else, you can pick up on the nuances, and you'll have a much stronger way to be confident about the direction of the market. And how much better could your trading be when you're confident about the direction of the market? Not to mention when the market's going your way and you're trading long in a long market, much better, right? And yes, there are some specific patterns that we look for to confirm breakouts and confirm reversals. We'll talk about some of them later. There's a handful of them. All right? So, what are we going to get out of this? Number one, you don't want to fight the market, right? Number two, use the market's trend or the lack of the trend to be in the right stocks for the current market condition, all right? And if you know how to do this, you'll also find stocks for future days. So that takes us to step two. Now that we know how we're going to figure out which way the market's going, how do we know which stocks? All right? In other words, which stocks, what day? Well, we're going to use the same basic formula. All right? So now, instead of looking at now, and this is incredibly powerful. In fact, I don't think most people understand the power of this relative performance that I'm about to show you. Right? And I don't say that with any disrespect. I say that because I know that people who have come back to me after seeing a presentation like this and applying it and say, you know, the more I look at this, the more it all seems to come together, and I get it now. All right? So, unfortunately, there's limited time here, and I want to show you all three things so you can put them all together. But if you take IBB down here, and we just look at IBB by itself, this is consolidating near the opening range high. All right? Great. Is it going to go up or is it going to go down? Don't really know. If it breaks out here, it looks like it's going to go up, right? It looks a lot better. It looks even better if you were to consider the fact that IBB rallied on this day while the SPYs sold off. When the SPYs rallied up to the highs, IBB was already there and consolidating. When SPYs sold off, IBB held like a rock. So now IBB is leading the market. And when the SPYs break out, which opening range breakout do you want to be in? You want to be in one that already wanted to break out, and now the market is just pushing it over the edge, and that's where you can get these massive moves up. All right. Not only that, oftentimes an IBB will, or a leading stock, will take off, and I'm going to show you an example of one of these today. Will take off, and then if the market up here, the SPYs, fall, it'll hold. If it's good, it will hold its opening range high. And so IBB is an ETF. It's the biotech ETF, but it could be any individual stock. Now, if we look at the daily chart to give you some context, this is the day that we caught in IBB. So if you're looking for, if you're watching IBB, and the reason I have this is because this is the trades that I did, right? So I'm watching IBB. I see that it's breaking, looks like it's breaking the base on this day, and I know I can use the opening range to time my way into it at just the right time. Will I miss some if it gaps higher and just goes? Yes. But won't you feel a lot more comfortable knowing when you're getting in that you have a high percentage, again, of it closing higher for the day, right? So I can, if I'm swing trading, which I was, I can take profits and be profitable even when this thing pulls all the way back. That's the idea of being in at the right time. And when I said earlier in the presentation, with maximum potential, we're not going to just do this on any day. We're going to do it on the right days, on days where breakouts have a higher probability or huge moves have a higher probability. But the thing I want you to walk away from with this slide is having relative performance, which is really easy to see in when you're using the opening range, is incredibly powerful. All right. So here's another example, slightly different. In this case, up top, you see that the S&Ps or the SPYs break their opening range. Now that should be negative, right? But sometimes the market will be choppy and it comes right back in. We call that an opening range reversal. We actually look for that pattern. It's how you buy against the low. But look what happens to AMGN on the same exact day. It doesn't break down at all. So as soon as that market starts to turn up, or when AMGN starts to turn up, and you know that the market is weaker, you know that AMGN has a great percentage chance of breaking higher and not taking out the opening range low, even if the market rolls over and goes down. All right? So if you look at that pattern, it's same basic application, just a little bit differently. Now, if you look at how that lines up on a daily chart, again, this is how, when the market was flagging, I could look at this and say, you know what, I'm buying basically the bottom of this flag. I can have a stop below the low of this day. I could have a stop below the low of this flag, and I'm getting in at a great price. And I'm getting in before the flag resumes. So when it starts to break out of that flag, I'm already in. Now, if I'm wrong, I haven't taken a big risk. Does that make sense? That's why, look, I started trading as a day trader on the floor, and this is where I learned this. I didn't make this up. I've adapted it, come up with rules to try and make it easier, come up with patterns to make it easier. But as I said, and it's not just me. We have a whole team here, and I've been partners with Keith, who was my mentor from 1990 for 20-something years. So this is day trading timing, which you can apply to swing trades as well as do day trades. Would anybody disagree that if you were going to be a day trader in AMGN in that particular slide, buying it against the low of the day, nice entry, you could even sell some against the high of the day and you've made twice what you would have been risking. If you're an options trader, don't you need to time your entries if you're a directional options trader? So that's what this is all about, timing your entries with intraday action that's really easy to see. You don't have to sit there and watch every tick. All right, and I'll show you how I set up my screen to do it. So here's an example of Amazon just the other day, right? So Amazon announced earnings. I don't know what you think about Amazon. I want to be in Amazon before it breaks out, which you can't see here. 685 happened to be a big number, and then 690. I want to be in it before it breaks at 700. I don't know if it's going to break 700, right? I'll take a lot of small risk trades so that when it gets to that 700 and there's all that volatility, I'm not worried about it. I'm already in. So this was my first opportunity. Earnings came out, gaps higher. The next day, here's the next day. So the high from the earnings day happens to be this level here. 5-minute chart again, and look what happens. Opens higher, rockets higher. Look what the market's doing, kind of waffling around, and then moves higher, holds the high of the day, moves higher, starts to break out over the high of the opening range. Now I see this thing breaking out over the high of the opening range here, and the market holding steady. Look how long this spends up here. I don't have to be watching every single tick. Can everybody hear me? Can everybody hear me? Someone's saying no sound. Someone could just give me a yes. I don't have to watch every single tick. We just look for the big patterns. Great, thank you. We look for the big patterns, and at this point, I know that this is potentially the day, right? And I could put an initial really tight stop down here and another stop down here, and by the end of the day, I've already made what I risked. So I took profits at the end of this day because it was bumping up against the big number up there. All right. So $15 or $10 into it in the day, take some profits. Now if it pulls back, which it has, I have the opportunity to either buy it back or that position is profitable and I can have a wider stop. All right. So that's the stock versus the market. All right. The second huge key here, and if you put all these things together, as I said, it's incredibly powerful. This one, again, some people will say it's just too simple. So I'm going to show you how you can go and just test it for yourself. This third secret to this process is looking at the prior day's range. Good trends on daily charts don't break the right support, okay? In fact, they don't break the prior day's low, and they even more rarely close below the prior day's low. All right? So if all you did was focus on where we're trading relative to the prior day's low, a lot of traders could do a lot better when they get the hang of how this works. All right, I could spend a whole webinar showing you how to do this and different nuances and simple but elegant rules. I'm going to do it fast forward. All right, so once a market establishes some momentum in a direction, a couple days in a direction without trading below the low or above the prior high. So in this case, you can see the market's head lower. Again, I'm just looking at the SPYs. You can do this with anything. And in fact, one of the things I will do when I first pull up any chart is I'll look for this pattern. I'll look at how this particular stock, ETF, future, whatever it is, respects its prior days. Some are much better than others. SPY is pretty good. So if we were just following this down, and I'm bearish until this trades over the prior day's high, right? So finally it gets down to this level, and not only does it trade above the prior day's high, it closes over the prior day's high. Now I want it to continue. So if it continues through this high, now I know I have to just start watching the prior day's low. Now, follow my thing here. Tell me when it finally trades below the prior day's low. Right here, okay? That's almost 2 weeks. That's a huge move. It doesn't close below the prior day's low, and it doesn't follow through. So we're still going. If you're patient. Here, trades under it, but definitely doesn't close there. Still going. Still, I don't even know if I can call that trading below it. I can't really call it trading below it. Finally, right here. Okay? So from right here to right here, without closing below the prior day's low. All right? Now, once you do that, you want to see it follow through if you're going to be really patient. If you want to be out quick, you're out right there. Otherwise, you want to see it follow through. In this case, it doesn't even follow through, which means you're back and you're up here. Now here it finally does follow through. It closes a little lower. If you didn't believe that one, it's right here. So even if I took you from here to here with that simple rule, most of you would not complain, although you would have to sit through this. But here's the flip side. Let's say you're just looking at it from the standpoint of, is this market strong or choppy? Well, closes here, can't make a new high, closes here, this is beginning to look choppy. And this is what I mean when I say there's some simple rules you can put together, and all of a sudden you've got a really easy way to know that the market's choppy. So now you have this, it follows through. Now you're going to track the highs of the day, all the way down, all the way down, all the way down. Now in this case, gaps higher, this makes it tough. It'll happen. Once you've gapped higher, you've closed higher and following through, so now you're following it to the upside. Close lower, follow it to the downside. Close higher, close lower, following it to the downside. See what you do? You can just follow it, follow it, follow it. It will keep you on the right side of the market. But more importantly, all right, like I said, take any market, go do it yourself. I only say that because I know we want to get to the next step. So what does this mean? If you put all this together, how many of you struggle with the right place to put your stops, right? Knowing what you know now, where do you want your stop to be? Under a daily low, under the prior day's low, under the multi-day low. So what, and let me tie this back. The opening range is the low of the day 27% of the time, and if you apply the 83% trader's advantage, 62% of the time. So where do you want your stop? That is most likely going to be the low of the day by the end of the day. So that's your daily low. I just showed you the prior day low, how powerful that is, and a multi-day low is just as powerful. All right, so put these two things together. I didn't talk about volume in this presentation, but that's another place to look. If you take the daily range and the opening range and use them in conjunction, you will be able to trade with the basic trend. You'll be able to identify key reversals, right? So it's time to learn how to trade with the opening range and get that advantage. When you can do that, you really can pinpoint intraday reversals and identify the days that are trend days. All right, so here's a couple more examples. IWM. Here's an example. I did this, right? So we've got multi-day lows in here and this individual day low right here, and that's the day that you have this market looks like it's terrible, comes back in, does an opening range reversal pattern, and you're able to put your stop below here, so below here, right? And from there, off and running. All right. Now, even if you didn't want to take it as a swing trade, not a bad trade for a day trade. Amazon. And notice what I'm doing. I'm looking for specific situations where the market has potential. In this case, Amazon, nice consolidation here. This happens to be the 10-day moving average, and it's pulling back into this daily area of support. Now, without the opening range, I wouldn't necessarily have the pattern to get in. But with the opening range, I do. I know that if it takes out the opening range and not by much and comes back in with the reversal pattern, that's the day I can look to be a buyer with a stop under the lows. All right? So using these two things together enables you to have an amazing ability to time. AMGN, right? Notice this is in an uptrend. This has pulled back for 3 days. We talked about this one earlier, right? Buying against the low of this pullback, which also sits near support. And that's going to look like this. So even in this case, if you're a buyer here and it runs up and doesn't close at the high of the day, but instead just closes at the middle of the day, you're going home profitable. Much easier, all right? Much easier to trade this way. Would you agree? So if you're day trading, can you see how buying at on the right day, at the right time, will enable you to trade better, hopefully for bigger profits? Because for one, even if all the stock does, or the ETF, or the market does, is move back to the high of the day, if you've chosen the right trades, you can get twice what you've risked just going back to the high of the day. And if it breaks out through the high of the day, home run. All right. Now, the other thing that this does for you is it enables you to wait confidently for an opening range that makes sense, that's lined up with daily highs or daily lows, and that's when these massive moves happen. All right. And when you get more experienced, you can actually add to your position when you've bought near the low of the day and then it breaks out, because you'll know which days are the best to do that with. Now, if you're swing trading, you may not want to be sitting in front of the machine all day. You don't have to be, right? All you need to do is understand which day to focus on. And it also applies to when you're going to take profits, right? So if you can get into a trade and take profits the very first day because you've gotten in at the right time, doesn't that make trading a lot easier? All right. Won't that give you more confidence to hold overnight when you're going home profitable? Right. So if you follow this webinar's trading strategy or this tactic, you'll have a much higher probability of entering trades on the right day. And it's really based on looking at the daily chart and finding the right area on the daily chart, and then letting the opening range tell you the right day to get in. All right. So this is what I mean, and hopefully you can see what I mean by saying when you use the opening range and the advantage that trading can be a lot less stressful and more profitable. All right. Imagine looking at a stock that's trading down near the low of the day, where most traders are saying it looks terrible or looks bad, and you're able to look at it and say, you know what, this looks good. This looks like an opportunity, and I know how to control my risk. All right? Won't you feel safer with your stops now under the day, under the low of the day, and under hopefully the prior day's low, so that they've got good support? I think you will. All right? But I have to warn you, right? I've shown you how to do this. I've shown you what it's about. But don't expect every day in every stock the opening range is going to be the high or going to be the low, right? Some days they're just going to break down. You need to understand when to look for that reversal and when to look for that follow through. I can't cover everything here, right? So what am I talking about? Apple, actually this is today, good example. So Apple opens higher, looks good, and then comes down, even consolidates around the low of its opening range, but then falls out of bed. All right? So it's not always going to work. You need to know which reversal patterns to look for, right? And you need to know how much you're going to give it below the low of the day, and you need to know which days to do it. All right? So even here where the market looked good, this one did not. This one didn't hold up. All right? Now, I watch Apple a lot. I watch IBB a lot. So IBB is another example here. Got off to a let's call it an unchanged start. Got hit pretty hard. Comes back, consolidates around the opening range low, and bam, down again. The next day, sells off to near the opening range low. You get a reversal pattern, and this day it works. All right, so you do need to realize that I don't want anybody just running and buying stuff just because it got to the 30-minute opening range low. All right, and there's so much more that the opening range can do for you. All right, in fact, some of that includes their really precise reversal patterns. If you apply those, you can be really specific and really tight on your risk. Not only that, when the markets gap, sometimes all you have to go with is these opening ranges And we'll not only use the 30-minute opening range, in the right instances, we'll use the 5-minute opening range as well. All right, but the rules are different. We also look to see which opening range have the best percentages. That's the 83% advantage. And so we use a few indicators there, and we also do use a few indicators in terms of identifying where you've got what I describe as maximum potential. And there's specific patterns to when you want to look for opening ranges. And you saw some of that in the examples that I gave you. We saw some of those flags and dots. Those are situations where you have a higher probability of that maximum potential. All right? And you need to know, what if the low of the day is not the pull? What if the low of the day is not a pullback? Right? So sometimes you can't get the low of the day of yesterday in the opening range. So what do you do then? All right? You'll be able to anticipate where the reversal will happen before the market even opens when you get the hang of all this. All right? So as I've said, if you just focus on this one strategy, right? Pullbacks in strong markets, buying against multi-day ranges in low and choppy markets, buying weakness before a daily breakout in a strong trend. That's all you would have to do, right? I mean, hopefully you can see the value of this. If this is all you do, is tremendous, all right? And you're probably thinking, right, what about the reversal patterns? How far below the low should I put my stop? What are the best profit targets? What are the best trailing stops? How do you avoid the frequency, the high frequency traders if you're looking at this intraday price action? All right, there's plenty of questions, I know. Unfortunately, I can't answer them all in this short time period. So that's why we have a course, streaming video, called the AM Trader. And in this AM Trader course, there are 3 models that will provide you with complete systems for trading, for the day trading portion of this, which gets you into trades whether you're a day trader or a swing trader. It can get you out of trades whether you're a day trader or a swing trader. I use these same techniques that I've told you on identifying when it's time to get in, to also know when it's time to get out. All right? You'll know entries and exits, profit targets, and easy setups for all market conditions. All right? You'll have precise ways to identify reversals, precise ways to identify the breakouts. You'll also have tactics for avoiding the noise of high-frequency traders, right? And exact rules for where you should set your stops and targets. So there's 3 modules. The first module is all about the principles of the opening range. The second module focuses on exactly how to trade the opening range reversal, we call it. That's the pattern I've been showing you, where it comes down to the low of the opening range and then reverses. And then module 3 is for breakouts. More specifically, those breakouts that happen right in the morning, like gaps, and the quick breakouts that happen right as the market opens. All right? And this also helps you in terms of how to handle false breakouts. Apple today was a good example. Took out yesterday's high and immediately reversed, but this tactic would have kept you out of Apple. So the course, the AM Trader course, is a lifetime access to streaming video training. So as soon as you get access, you'll have access to the whole thing, and that's normally $497. But because of this presentation, I have a lot more for you than $497. For one, I want you to have mentoring for an entire year. Every week, I put out what we call the trade plan video, and the trade plan video takes you through a process of how we determine what your bias for the market should be for the next day, for the next week. Simple rules, much like the ones I showed you with where are we relative to the prior day's low, and we establish whether we're going to go into the day bullish or bearish. Then I look at, it says 2 to 4, but it's really been more like 4 to 8 specific stocks, and I walk you through why I would focus on these specific stocks and where I would look for breakouts, where I would look for reversals. So how do I know all this or know where to look for them before the market even opens? Well, you'll learn all that. And it's not magic, it's just experience and being able to see the charts in perhaps a different way, as I've just shown you so far. Right? So if you'd like a video, and this video comes out every Wednesday, that walks you through this plan, stocks to follow, how to follow them with the opening range, then this is your opportunity entire year. Not only that, every day we put out a focus list. So this is a longer list of stocks that are in good condition, good spot to focus on the types of trades that I've just talked about. Now, this mentoring is normally $97 a month or $1,164 a year, right? But I'm going to include that in this particular package. In addition, I'm going to include a bonus of a package of 20 what I call the best of training videos. So for our another service, we've put out training videos that focus on using the opening range and just trading in general with slightly different setups that leverage the opening range, with additional indicators that leverage the opening range, and even look at specific trades and walk you through those trades to give you more experience. So there's 20 of these. I could easily put this together and call it its own course, but I'm going to call it a bonus and give it a $200 value. And finally, I've talked about this 83% trader's advantage. Right? There's 3 conditions that you can know before the day opens that will help you to evaluate whether or not tomorrow your stock has this 83% advantage. And what that means is that on a normal day, you'll have 27% chance of the low being the low. On a bullish day in the 83% trader's advantage, that goes up to 62%. Right? And the same thing flips over for the shorts too when you want to know when the high is going to be the high of the day. Right? So that 83% advantage, I'm going to put it at a $97 value, but really it's worth so much more. And finally, we have put, in the past, I did a couple-hour session for new members of the AM Trader and called it the OR Bootcamp. And so this becomes a fast track to success training class. What I did with this is I kind of boiled everything down in the course and said, look, if you're just going to start and get started with the essentials, this is what you need to do. I walk you through step by step how to identify the best trades for your trading style, day trading or swing trading, and help you master the analysis of the condition of the market, multiple time frames on your chart, and the condition of the opening range so that you can get started right away. It doesn't replace the course, but it will get you started right away. And it includes a PDF outline, a kind of a check mark process, also that you can evaluate trades more quickly. All right, so the total value of all this, if I were to add it all up, is $2,358. It includes lifetime access to all the training and all the bonuses and a full year of the mentoring. All right, all that if you get in and get registered today for $497. Now, if you go to our website and buy AM Trader, all you will find is the AM Trader course up here, $497 for $497. So, look, MarketFest has been a great experience for me in the past. I think the whole idea of getting together a bunch of traders who really want to help others do better. If this type of trading is of interest to you, that is getting into your swing trades at the right time, being more effective at day trading, then I encourage you to learn everything you can about the opening range, and I don't think you'll find a more exhaustive program for enabling you to do that than the AM Trader, especially with the year of mentoring. All right, so I'm going to take some questions, but while we do that as well, I'm going to pull in my charts. I'm going to look at some charts from today, as I promised that we would do. So the first, and while I'm doing this, just all you have to do is go to MarketGauge.com/MarketFest, and I think I can put that link let me put that link in the box. Dan already has, I think. So click on the questions box, and if you do type in marketgauge.com/MarketFest and you get page not found, I can almost guarantee you've misspelled MarketGauge incorrectly, as I still do, even though I've been typing it for going on 20 years. All right, it's AUGE. That's what everybody messes up. They say MarketGUA, but so just use the link. All right, so quick question: does the mentoring include futures? All the mentoring does focus on stocks and ETFs because that's what we primarily trade, it's applicable, right? All the rules are applicable. When I traded on the floor, I traded cotton options and the dollar index because those two pits were right next to one another. I use this for both at the same time. So it is applicable conceptually, but when we're going to give you a list of stocks and ETFs, we're going to give you the mentoring is going to focus. The mentoring is going to focus on looking at, well, here's my screen. All right, so I will start each mentoring session by starting right here. Where's the market look like? Last night I was my message was bearish. Many of you could probably figure out why based on what I've told you already. Maybe some of you get some of our other material, and you could figure it out from that too. So we start here, and so when I say does it apply to futures, if you trade E-minis, the message might be helpful, but the symbols will be different. So let's take a look actually at today's market action. Let's go to Market Watch. I'll go back to the 5-minute. So can everybody see my charts? So a couple of questions that relate to each other. Yes, you can see my charts. Great. All right. So someone's asking year-to-date performance. We're not giving you exact entries and exits, and we are also, so for that reason, we don't have a year-to-date performance. But even so, where we do provide year-to-date performance in our services, we only do that when it's absolutely crystal clear what trades you would have taken. And so in this case, it's applicable to so many different markets and symbols that we wouldn't be able to do that. All right. And so, Peter, that should also ask you a question about discretion. We have patterns and setups, and there is some discretion, no doubt. It's just not totally black and white. So let's take a look at today's price action. The market opens lower, and as far as these moving averages, you don't have to worry about them. Once we have today's price action, and let's just focus on the SPYs. Here's the 30-minute opening range, and here are the Qs. Here's the 30-minute opening range. Here's the IWMs, 30-minute opening range, and the Dow, 30-minute opening range. So first things first, the SPYs try to break out, but they don't have a continuation pattern. So not only do they not do it, but the Qs over here even less so, and IWMs even less so. So the Dow was one that did break out, did have a continuation pattern, but none of the other ones did. So no surprise that when it starts to fall back, it's a significant fall back, right? Now the other thing that you want to weigh into this is that 205 on the SPYs is a big number. So this is a great opportunity right here for some traders to have a low-risk entry if you want to buy against the low. It's a great opportunity if the market really breaks down to get in with, I would say, a low risk stop, because for one, it really shouldn't come back up over today's high today if it does break down. But look what's happening, right? So IWMs have broken down, and they're telling you that this market is under pressure. So one of two things needs to happen for something to be activated. One, these markets need to follow the IWMs lower. They haven't done it. Or two, when these markets reverse, IWM also really needs to reverse and get back into its opening range. Until then, you can just sit back and relax. Let the market figure it out. So someone's asking the magenta. Magenta line is the prior day's close, and the green line is the prior day's low. All right, so here's a little more than what we got into, but one of the reasons the Qs couldn't get through the opening range high is because they were stuck at the prior day's low. All right. So with that context, the market looks like it's going to get off to a good start, but then it falls apart. So here are some of the stocks that I was watching this morning. All right, some of these some of you may have even seen the free video that went out last night. So this one wasn't in it, but this is one I have covered in other webinars. This is one that I've been in. And take a look at McDonald's. So here's the daily chart of McDonald's. This one's already reported earnings. It's now above where its earnings day is. And it's taking out the prior day's high. At the same time, it's breaking out of its opening range. Now, remember what the market was doing at this point? The market was just trying to break out and get back up through the prior day's close. In some cases, just trying to get through the prior day's low. So McDonald's, strong trend, not listening to the market, and breaking out and following through. And not only that, now it's pulled back some, but we just saw what the overall market's been doing. The IWMs are at the lows of the day, right? This thing explodes higher. So how do I find it? Well, as I said, this one has been on my list because I'm already long and considered adding. I didn't add because I have other longs, and the market really didn't cooperate. But had the market been more cooperative, this is where I would look to be adding. All right. So here's in terms of ideas to look for going forward. Facebook. So look at how this thing is acting today. This is, earlier I said you can use this to find future trades. Facebook, when the market, and you know what, let me pull up the market down here. So here are the Qs down here. Can you see how straightforward? Does anybody see any difficulty in trying to apply this type of analysis to what they're already doing? How big of an account do you need? You don't need your account size could be anything, right? It totally depends on how you want to trade. Try and get this lined up. There we go. So the key here, though, is that you need to know when you have a continuation pattern and when you have a reversal pattern. And when you know that, then you can be much more confident about which ones to follow. But you already know this is a key inflection point. All right. So if you have some trading experience and trade around inflection points, then you know that Facebook breaking out ahead of the market, if you like Facebook, which I do, but I'm already long, so I didn't need to add, breaks out, and when the market sells off, look, I'm not going to say of course because McDonald's didn't sell off, but Facebook came back and held that support instead of going all the way down to its low of the day where the market did. Why? It's telling you here it's a stronger stock. Right? Now, on a second attempt, and the market back down near its lows, not so sure. But let me ask you a question. If the market had looked a lot better and Facebook was continuing to break out, wouldn't this be an opportunity where you could be a buyer in here with a stop under here? Or if you had been a buyer through here and put your stop under the swing low, you're still in, even though the market has come all the way down, made a new low for the day twice. Okay? So someone's saying, how do I prevent analysis paralysis? Here's one way. You focus on the big picture. So I have my charts set up where I can see about 8 charts that I'm watching on a 5-minute basis, and I just focus on what's the big picture around the opening range. Is today the day on a daily chart to be looking to get long? Now, the reason to get long today would only have been if you thought that that 205 level was going to hold and you wanted to take a shot. But the markets have not really done anything to suggest that that's a huge opportunity at this point. All right, so today would be a sit back and pretty much watch what acts well, and for that, and knowing that, you'll be able to check them out tomorrow. Now, on the short side, IBB, when IBB breaks the 30-minute opening range at the same time that the Qs are rolling over from their highs and it's below all this, there's one that you don't expect to come back. So that's kind of the big picture, right? You get the big patterns, either you have them or you don't. If they're not obvious, then you walk away. All right. Now you'll get more descriptions of everything that you'll get here at MarketGauge/MarketFest. I'll give you 2 more that I'm watching, and you can see how they've been acting. Amazon, and then I got to wrap it up. So Amazon, look, it came right back down to the low of the follow through on the earnings day. Now it's breaking out to new highs. This is one, if you like Amazon, I'm already in it, so I'm not going to add to it, but this is leading the market higher. If the market doesn't make a new low, I would expect that this thing could easily move higher, and I could put a tight stop under this level and a better stop under the low of the day. All right? Now, I don't have to sit here and do a whole lot of analysis to figure that out because I know the pattern. Now, today's not the best of days. If we were in a bull market, right, this would be a no-brainer. This is trying to pick a low in a rough market. But I'm doing it in a strong stock at the right time, but that's how it all comes together. All right, and finally, for those of you who like stocks in the basement, I think one that looks interesting here is LinkedIn. This one is acting a little bit better than the overall market. But what am I going to wait for here? If I could get LinkedIn with a 30-minute opening range breakout that looked like Amazon right now on a flag right here, I'm trying to get in below this 130 breakout level. It's really a breakout with a huge gap. All right, so hopefully you can see how I can get really tight risks, identify stocks with really huge potential, and I don't have to sit here and watch every single tick to make it done. And we'll show you exactly how to do $2,300 worth of value for just $497 if you go to MarketGauge.com/MarketFest. And that's it. They're going to haul me out of here for violation of the time right now. All right. I hope this helps. I hope this really pays off. And for those of you who already know us at MarketGauge, great to have you back in another presentation. So thank you very much, everyone.